So greetings everyone. Sorry for the delay on this video. This is the one of my professional video conferencing recording sites. I tried Blackboard, it didn't work. I tried Zoom, which is another one of my accounts that it didn't work. So one of the things, a lesson learned for video conferencing software is to have a number of tools available. So I use GoToTraining, I use Zoom, I use WebEx. This one is the one that seems to work this time and mesh well with Blackboard. So what I wanted to cover on Wednesday was additional information on the cost structure and cash flows associated with that. So what I have here, and you can find this in the tools section of the content area of Blackboard. This is from an economics class that I teach, and this is an example of what I use to help illustrate some of the cost structures that you all should consider as you develop your business proposals. Now, it's not something that is required, but those of you who have worked ahead or are further along in development of your business proposal may wish to consider this additional means of looking at the cash flows and the capital structure as well as the operating structure. So operating structure refers to the mix of fixed and variable costs in a business. Fixed costs are things that do not change throughout the accounting period. They can include things like rent on a facility, insurance, taxes, salaries of employees, anything that can be fairly predictable or very predictable throughout the entire period. Those are fixed costs. Variable costs tend to be costs that are directly associated with the level of activity. So if labor is necessary to produce, let's say, a bottle of wine for John or for Daniela with consulting, her labor is going to be directly proportional to the amount of work that she does. She might charge $200–300 an hour. That's a variable cost. So if she works 10 hours, that's $3,000. Whereas if Daniela or let's say Aaron's business, the rent that she plans to pay, that is fixed throughout the duration generally, for or at least a year. There might be provisions on a contract for annual increases or what have you, but for each accounting period, that is fixed. So one of the challenges I find the students have with differentiating between fixed and variable costs is not so much what they are, but it's the relationship of them as activity changes. So I'm going to start here with a series of costs that are laid out plus some revenue for a single firm or a single product firm or a single service. So over here we have the quantity of items produced. The total fixed costs. So here, the fixed costs are $100. Let's say that's rent for the building. And notice that with the activity, with the increase of quantity, the fixed cost does not change at the aggregate level. That is at the total amount paid at the end of the year. Now, variable costs here in this column are costs that are associated with the level of activity. So the more you make, the more that is incurred. And so you'll see here the variable cost, the total amount, increase. So here's the first challenge that some students have. At the aggregate level, the amount you write the total check for, fixed costs are fixed, but variable costs vary. At the individual level, over here, like for instance, average fixed costs, notice that for one part or one product sold, it's 100. For two, you divide the fixed costs by the number produced. So 100 divided by 2 is 50. 100 divided by 3 is 33, and so on. So what we see at the unit level is that fixed costs vary at the unit level, but variable costs are fixed at the unit level. Okay, you don't have to know this for this particular course, but I do want to highlight some of the relationships about how you choose to finance your business and how you choose to run it, the operating side. So we have our total fixed cost, our total variable costs, and the total costs are simply the sum of total and fixed. When we produce nothing, our cost is 100. This is the cost associated with, if you do nothing at all, you still have to pay the landlord, for instance. So as we take the averages, we can see that the average total cost here starts off high and goes down and then starts coming back up again. This is typically because as an organization runs up against its capacity constraints, how many you can produce in a day or a week or what have you, or a 5-day week, it costs more to do the same thing, whether you have to pay overtime to have employees work on the weekends or whether you have to outsource to another company. And so because of the effect of the total fixed costs being divided amongst the units, initially the total costs come down, but then they start getting pulled back up as the organization nears its capacity constraints, how many things you can do in a period of time. So how do you know how much you should produce? Well, from a purely cost perspective, you want to look at the marginal cost. That's this column here. And marginal cost just simply means at the margin, the next one. So the marginal cost of going from 155.70 to 102 is 49.90. And they decline for a while. Now, the idea here is in marginal cost, and those of you taking calculus, you may recognize this. The idea is that at least at quantity 4, which I have highlighted here in yellow, the average variable cost is equal to the marginal cost. That is, for the cost of producing one more, the labor cost is exactly related to the total amount of costs that are increasing. At quantity 6, which is in orange, the average total costs are equal to marginal costs. That is, we take the fixed and the variable at the unit level, and then we look at how much costs go up by each one, and we try to get the point where average total cost is equal to marginal cost. This is the most efficient level to produce at. So while the organization can make 12, it's at 6 that the organization is the most efficient using the costs. Now, if you want to make more and be efficient, then you would turn your attention to how can I make my cost structure more efficient? Do I automate, for instance, and get rid of some labor? Do I change materials? These sorts of things. Now, let's take a look at the second side. Assuming this organization operates in a purely competitive environment, remember, the organization in this environment is a price taker, cannot vary the price no matter how much it makes. So whatever it is that this organization is selling is $110. So the total revenue then is just simply quantity times the price. So 110, 220, 330. So this is increasing at a linear rate. Now, marginal revenue, the same idea as marginal cost. How much revenue do you get for each additional one? So this is fixed. That's why it's linear. The price does not change. Our total profit then is a function of our revenue minus our costs. So when we make nothing, the total profit is a loss of $100 because you still have to pay the rent. If you make one, you get $110, but the costs over here in yellow, $155. So there's a $45.70 loss. With two, there's a slight profit because there's $220. It costs $205.60 over here to produce, and so forth. So the most profitable place to produce, the profitable number, is 8. That's where profit is maximized. Now, here's one of the big dilemmas that I encountered as an MBA grad and working with small businesses and trying to get them to understand that just because you can make 12 or you have a bunch of machines doesn't mean you should run them all. So when I was a division manager, we had about 55 plastic injection molding machines, and the owners told me they were happiest when all the machines were running, but they were still puzzled when it came time to do the quarterlies why they weren't as profitable in some quarters as others, or why they were actually generating a loss when they were running all their machines at full capacity. That problem was a little bit more complex because there was about 5,000 different parts that could be made. And it was all in the mix of which ones were running and when, and trying to explain to them that it wasn't always profitable to run all the machines all the time took an analysis like this and a lot more work. It took me about 6 months to convince them. But many organizations focus on get out there, get the sales in, revenue, revenue, revenue. That's not the efficient way to maximize your wealth, because you're in the business to profit the most. Notice here that total revenue is maximized at 12. That's 12 times 110. But look at how much profit was made over here in green, $10. It was more profitable to operate at the 8 at this level here. Let me highlight this one in orange. Why was it the most profitable? Because that's where the costs were starting to pick up, but not too high. The most efficient would be 228.80 in profit. 261 is maximizing at 8. The costs are starting to come up at this point. And so, again, this was a graduate course that I was teaching, but I want you to think about how you're going to mix the costs of doing what you're going to do with your business. What is the mix of fixed versus variable? I mentioned in the context of discussing consulting with Daniela, she's in the ideal position where has very little to no fixed costs. She only incurs costs, ideally, when she's doing work for others. So almost pure variable costs, which means that when work activity drops to zero, in some instances, she has no costs. Now, she might have some costs like cell phone contracts and office equipment and things like that she needs to do her job. Those might be marginal at best. But she's operating primarily a variable cost business. Same with Thomas. Most of you that have a product or service, though, and are going to have a physical location, are going to have to deal with fixed and variable costs. So what is the mix of your fixed and variable costs? And that's what I have for today. So coming up for next Wednesday, we have update number 1. Now, click on the course content. Right here is the link. Just click on it, and it's just like the business plan proposal. So what I'm looking for is an update. Ideally, I would like to see a mission statement. Remember, those should be measurable and concise. 1, 2, 3 sentences max. Perhaps start discussing the competitive landscape. Purely competitive marketplace, monopolistic competition, and the like. I doubt anyone, I can't imagine anyone is in the oligopolistic environment. Who are some of the competitors? What is some of the value that you plan to bring to your business? Remember the 5 sources of value: form, time, place, transaction, and information. If you have any questions, send me an email, give me a call. I can work through them. But ideally, I would like to see update 1 posted by the end of class next Wednesday, which is the 16th. I look forward to seeing you all in class. Take care.